Okay. Hi everyone, very excited to be here today. So impermanent loss is probably one of the biggest issues in DeFi right now. And today I would like to deep dive a little bit more around it. So notably I want to show you why it's a big issue for more widespread DeFi adoption. I want also to give you more details about how it impacts your portfolio and how you can optimize your farming strategies to avoid it. I want to give you also more visibility on the options that you have to remove it and what are the trade-offs associated with it. And the last part is I would like to show you what an impermanent loss-free world would mean for us. So as for myself, I'm Cyrille Pastour. I'm the co-founder of Swap protocol. We are a new AMM that strongly reduces impermanent loss that just launched on Polygon. And I spent the last year basically studying impermanent loss and its darkest secrets. And so that's why I want to share them with you today. So first, my conviction is that that impermanent loss is basically a key issue for more widespread DeFi adoption. Why is that? First, impermanent loss is really scary and acts as a deterrent for new users when they want to start using DeFi. AMMs, traditional AMMs, don't display it. It's like very sneaky. It's super hard to understand. And it's a very bad signal for retail traders. So that's the first part, which is more like a kind of feeling. The biggest part, of course, is that it's a huge problem for LPs. Automated market makers like Uniswap have enabled any type of investor to benefit from market-making strategies which in CeFi or TradFi are only for high net worth individuals that LP into funds like Citadel Securities or Wintermute. However, those strategies are basically not profitable, and that's a big issue. A study made by Bancor on UniV3 showed that approximately 50% of LPs in UniV3 were at a loss. If you translate that into absolute capital losses, it becomes crazy. On just 50% of the pool during 5 months, it has been estimated that $260 million have been lost due to impermanent loss on UniV3. So if you just round up to like the whole DeFi and AMM ecosystem, you can take billions of dollars every year of losses. And the worst is, it's not just a problem for LPs. It's also a problem for traders. And that's why also we really decided to tackle this issue with Swap. Basically, when you think about it, the trading cost is a function of two things. First, you have the price impact, which is the depth of liquidity that you can find in the AMM. And second, you have the trading fees. So first, trading fees. They have to be super high in order to compensate the LPs for the impermanent loss they're undertaking. So trading fees are usually around 30 basis points, which is huge for volatile assets. Then the price impact. Basically, a lot of people are refraining from providing liquidity to AMMs. So price impact remains a huge issue when you want to trade assets on-chain. So that's why, overall, I think that impermanent loss is a huge adoption issue for DeFi. So maybe let's dive a little bit more around what is it and how it affects you concretely as an LP so that you can further optimize your farming strategies. So what is impermanent loss exactly? Basically, AMM implement a kind of market-making strategy which doesn't include any external information. So what they do is that they determine the price of the assets just based on the internal demand that they have. The more demand for an asset, the more they sell, and the more the price increase. The problem is that essentially it means that they are always short in terms of inventory versus their initial inventory, the best asset, the asset that performs the best, and they are always long the worst asset, the asset that performs the worst. And that's how they undergo like strong capital losses when the prices of the assets start to decorrelate. So what are the consequences concretely? Maybe let's take an example, try to adapt what we've seen from the previous cycle and see what it would mean in our current setup. So during the previous cycle, the ETH price approximately did like a 30x improvement during the bottom from the ATH, right? So let's suppose that ETH is worth $1,000 in our scenario. If you start LPing now on a traditional AMM, so you will get 6% of losses if the price doubles. It's almost the case right now, I think, this week. You get 20% of losses if the price goes back to ATH. And then if we have the same bull run as we did during the last cycle, essentially you will lose 65% of your asset. 65% loss of your asset means that the AMM needs to perform a 300% return from the fees. So that's huge. So you're going to tell me, okay, impermanent loss kind of sucks when you want to be an LP and the price rises, but you're hedged when the price goes down. But that's not the case, unfortunately. When the price goes down, actually, the same scenario happens because the bad asset becomes the good asset. So in our case, when ETH price rises, the good asset is ETH, and the bad asset is DAI, let's say. In the case where the price of ETH decreases, ETH is a bad asset, so you accumulate ETH, but at a bad price, and you reduce your DAI position. So the same thing happens. And if macro is very bad and we start to have a very huge bear market and the movement is on the other side, things are going to get very bad for you. What are the solutions? To be honest, all of them have huge trade-offs, actually. So first, one thing that you can do is you can go for assets that are, like, you can choose, okay, I don't want to LP because there are too many risks. So you go into AVE or Lido, for instance. But risk, I mean, the lack of risk has a price, right? You get lower returns, essentially. The other thing that you could do would be to LP into other types of AMMs, like stable AMMs. The problem is that you don't get exposure to the underlying assets. So if you're bullish on Ethereum, basically you're going to get return on your stable, but you're not going to get return on your ETH. Then if you really want to LP, the solutions are not so great. First, you can spend a lot of time trying to analyze the position, adjust it in real time. You're going to spend a lot of money on gas, and you're going to take very directional bets, which means that essentially it's an active strategy, and it's not fulfilling the value of being able to provide a passive market-making strategy. The other thing that you can do is to go into a concentrated liquidity manager, so a product like Arrakis or Gamma, which basically manages your position on UniV3 for you. The main issue with those approaches is that they have not demonstrated alpha yet. Then you can go for more creative solutions. One of them, for instance, is to hedge your like LP position into an AMM. So Bancor used to provide that. Now they went back on this. You can do this also with Open, for instance. The big issue with insurance is essentially that imagine just you have a house. Insurance always has a cost. So you have a house and you don't want people to steal your stuff, right? You don't want any robber to come in your house, right? So one solution is basically to close your door, close your windows when you go out, put a lock on your door. Another solution is just to keep your door open, your windows open, and buy a home insurance. Well, that's exactly the same with hedging your impermanent loss. It may solve the problem, but it's super expensive, and it's not the best way to solve it. So the last, another option is to go for a PMM like Dodo. So the problem with solutions like Dodo is that they don't actually deal with another risk that they're creating by removing the stability of the constant product formula, which is called the inventory risk, and which is a very common risk in finance, actually. And then we have Swap. So basically, what we do at Swap is that our mission is to enable any type of investor to benefit from passive and profitable market-making strategies. And in order to do that, basically, we are building an AMM which strongly reduces impermanent loss, allows multi-asset pools like Balancer, which enables you to basically create index-like positions that nets you returns, and that has lower trading fees than traditional AMMs. We are using a dual approach based on Oracle-based pricing, which enables us to strongly reduce the arbitrage that is faced on traditional automated market makers. And we are also using a mechanism of dynamic spread in order to ensure that we limit the risk of the trades that we are taking. I'd like maybe to step out and zoom out a little bit and to show you why we would DeFi world without impermanent loss mean. I think we can maybe there are like three main use cases that would be enabled. First one is profitable market making strategies open for everyone. I think it's basically the purpose of DeFi to enable strategies, investment possibilities that are not available in TradFi for everybody without necessarily any skills. The other thing is the reduction of trading fees, because you don't have to essentially pay for the impermanent loss of LPs. And it will enable us to basically flip the centralized exchanges where most of the volume happens right now. I think the SEX dominance is basically 90% today. And the last part is also you have very interesting institutional use cases. So for instance, DAOs, when listing their token, can earn yield on top of the liquidity that they provide instead of just having to pay for the impermanent loss they incur on traditional AMMs. So yeah, thank you very much for your attention, and don't hesitate to come and talk with me if you're interested.
Thank you, Cyrille. We probably have time for a question, if someone's out there would like to ask a question. Yes.
You said that impermanent loss was also bad for the traders and not only liquidity providers. Can you explain how it is bad for the traders?
So essentially, the problem is that fees on traditional AMMs have to be super high in order to allow people to trade, to compensate the LPs for the impermanent loss. So what we've seen basically by studying the data is that on Uniswap, basically you have a different fee tier for the pools. And so for instance, for volatile assets, so what I mean by volatile asset is for instance ETH versus DAI, you have essentially two main pools. So you have a 5 basis point pool where the trader pays 5 basis points, and you have a 30 basis point pool. Essentially, people are losing a lot of money on the 5 basis point pool. And the 30 basis point pool is still very risky, but more acceptable. So if you want to create like sustainable LP positions on AMMs, you need to have fees that are high. And 30 basis points is really high for an asset as liquid as ETH.
Okay, thank you. I think if there's more questions, we'd like to take them outside so we can stick to our schedule. We have another speaker coming up. Thank you again, Cyrille.
Thank you.